Dividend investing. Dividend investing focuses on buying stocks from companies that pay regular dividends, cash payments distributed to shareholders, typically quarterly. These companies, such as Coca-Cola, Johnson & Johnson, or AT&T, are often mature, stable businesses with predictable cash flows. Dividends provide passive income, which you can either reinvest to buy more shares, compounding your returns, or use as a steady income stream. Dividend aristocrats, companies that have increased dividends for 25+ consecutive years, are prime targets due to their reliability. For example, Procter & Gamble has raised its dividend for over 60 years. To succeed, screen for stocks with a dividend yield, annual dividend divided by stock price, of 2 to 5%, but avoid excessively high yields, eating 10% plus, as they may signal financial distress. Check the payout ratio, dividends as a percentage of earnings, to ensure sustainability. Ratios below 60% are generally safe. Use platforms like Morningstar or Seeking Alpha to find dividend-focused ETFs, eating SCHD, or individual stocks. Reinvesting dividends through a DRIP, dividend reinvestment plan, can significantly boost long-term returns. For instance, $10,000 invested in a 3% yielding stock with 5% annual dividend growth could grow to over $30,000 in 20 years, assuming reinvestment. Risks and considerations. Dividends aren't guaranteed. Companies can cut or eliminate them during financial struggles, as seen with some energy firms in 2020. Diversify across 15 to 25 dividend-paying stocks to mitigate this risk. Also, dividends are taxed as ordinary income unless held in tax-advantaged accounts like a Roth IRA. Be cautious of yield traps, stocks with high yields due to falling prices, which may indicate underlying issues. Monitor company earnings reports and news on platforms like X to stay informed about potential dividend cuts. Index fund investing. Index fund investing involves buying exchange-traded funds, ETFs, or mutual funds that track broad market indices like the S&P 500, XLE VOO, SPY, or NASDAQ 100, QQQ. This strategy offers instant diversification across hundreds of companies, reducing the risk of individual stock failures. It's ideal for beginners or passive investors as it requires minimal research and historically delivers solid returns. S&P 500 index funds have averaged 7 to 10% annually over decades. The low expense ratios, actually 0.03% for VOO, make this a cost-effective way to build wealth. Choose a reputable broker like Fidelity or Vanguard and invest in low-cost, broad market ETFs. For example, $500 monthly investments in an S&P 500 ETF at 8% average annual returns could grow to over $1 million in 40 years. Use dollar-cost averaging to invest consistently, regardless of market conditions, to smooth out price fluctuations. You can also explore sector-specific ETFs, XLE XLK for tech, or international ETFs, XLE VXUS, for added diversification. Reinvesting dividends boosts long-term returns. Risks and considerations. While diversified, index funds still carry market risk. Downturns like 2008 can lead to temporary losses. Sector-specific or small-cap ETFs may be more volatile than broad market funds. Avoid high-fee funds, salvaging funds with expense ratios above 0.5%. Check fund prospectuses for holdings and fees, and monitor social media for discussions on ETF performance or new fund launches. Stay disciplined and hold through market dips to maximize long-term gains. Day trading. Day trading involves buying and selling stocks within a single trading session to profit from intraday price movements, often 1 to 5% per trade. It's fast-paced, requiring technical analysis, quick decision-making, and access to real-time data. Traders use tools like Level 2 quotes, candlestick charts, and indicators to identify short-term opportunities. For example, you might buy a stock like SPY after a morning gap up and sell before the close, capitalizing on momentum. Day traders often focus on volatile stocks, like those with recent news. Check social media for real-time sentiment. To succeed, use a robust platform like TradeStation or Interactive Brokers, with fast execution and low fees. Start with a small account, e.g. $1,000, and risk only 1 to 2% per trade. Develop a strategy, scalping, momentum, or reversal trading, and backtest it. For instance, a momentum strategy might involve buying stocks breaking intraday highs with strong volume. Maintain strict discipline with stop losses and profit targets, and track trades in a journal to refine your approach. Education is critical. Study resources like Day Trading for Dummies or follow experienced traders on social media. Risks and considerations. Day trading is high risk. Most traders lose money due to commissions, slippage, or emotional errors. The SEC requires a $25,000 minimum account balance for pattern day traders in the US, so check regulations. Market noise, random price moves can trigger losses, so focus on high probability setups. Time commitment is significant. Expect hours of screen time daily. Psychological stress is real, so practice mindfulness and avoid overtrading. Thank you for watching FinanceBit. If you enjoyed the content, please consider subscribing, click the bell button, leave a like and a comment. It will help us immensely. Until next time, goodbye.